Are you curious why some investors thrive while others panic? Well, let's take a closer look at how past bull and bear markets can help you stay calm during market turmoil. Hey everyone, and welcome back to the Surviving Retirement channel. And today, we're going to dive deep into the history of the US bull and bear markets stretching all the way back to 1942. This is a critical topic for anyone interested in investing, as understanding the cycles of the market can help you make better decisions and stay the course during turbulent times. But before we begin, I'd like to give a shout out to First Trust Portfolios who provided the slide you're about to see. My name is Peter Guidote, Chartered Accountant, Senior Portfolio Manager, and Certified Financial Planner. Let's get into it. Now, this chart offers a historical perspective on the S&P 500 index's performance during bull and bear markets since 1942. Now, it's fascinating to see how these cycles of expansion and contraction have shaped the overall market, helping us appreciate the importance of long-term investing strategies. Now, before we dive into the details, let's quickly define what we mean by bull and bear markets. A bull market is when the market rises by at least 20% from a previous low, while a bear market occurs when the market falls by 20% or more from its recent highs. As shown in the chart, bull markets have historically lasted much longer than bear markets. On average, a bull market spans 4.2 years with a cumulative return of nearly 149%, while bear markets average about 11 months with a cumulative loss of about 32%. But you'll also notice another color, a gray bar, which highlights periods of recession. A recession marks the contraction or shrinking of the general economy. It usually happens when people lose confidence in the future and cut back on their purchases of goods and services. Now, experts declare a recession when the GDP, or the gross domestic product, which measures the total value of what a country produces, falls for 2 consecutive quarters. Recessions can have a pronounced effect on people's lives, such as lower wages, higher unemployment, increased debt, and reduced opportunities. You will notice on this graph that more often than not, but not always, a bear market drop occurs at the same time as a recession. So let's take a closer look at this graph. Let's start with the early years. From 1942 to 1968, the market saw several bull and bear market cycles. One of the most notable is the bull market from 1949 to 1956, which lasted over 7 years and provided a massive return of 267%. During this period, the market experienced shorter bear markets, like the one from 1946 to 47. Despite these setbacks, the overall trend was upward, reflecting the post-war economic boom and the expansion of industries. The 1970s and 80s were marked by significant volatility, but they also set the stage for some of the most powerful bull markets in history. Take the bull market from 1987 to 2000, for example, which lasted over 12 years and resulted in a staggering 582% gain. However, this period wasn't without its challenges. The bear market from 1973 to 74 saw the market drop by over 48%, driven by the oil crisis and economic stagnation. Yet, as history shows, these downturns were followed by strong recoveries. Moving into the late 90s and early 2000s, we encountered the dot-com bubble. The bull market that preceded it lasted 12 years, but the bubble's burst led to a bear market with a loss of 49% over 2 years. The 2008 financial crisis was another significant bear market, with the S&P 500 dropping by 52% in just 1.5 years. However, this was followed by an impressive bull market from 2009 to 2020, where the markets rose by 400%. In recent years, we've seen shorter but intense cycles. The bull market from 2020 to 2022 was cut short by the pandemic, yet it still achieved a 114% gain. The subsequent bear market was brief but significant, highlighting the ongoing volatility in today's global economy. The market's rapid recovery post-COVID, followed by recent economic challenges, underscores the importance of staying informed and being prepared for both bull and bear market cycles. So what's the takeaway? The history of U.S. bull and bear markets shows that while downturns are inevitable, they are typically followed by periods of significant growth. These periods of growth, bull markets, last longer and have higher returns than bear markets. How significant is this? Well, a $10,000 investment in the S&P 500 index in 1970 would have grown to over 2.6 million in 2024. The bottom line is understanding these cycles can help you stay calm during market dips and remain focused on long-term growth. And remember, it's time in the market and not timing the market that makes all the difference. If you've enjoyed this video, make sure to hit the like button, subscribe to our channel, and ring the bell to get notified of our latest content. And if you'd like to know more about us, check us out on survivingretirement.ca, or if you'd like to get a second opinion, book your free 30-minute strategy session with a member of our team using the links in the description below. Thanks for watching, be kind to yourself and others, and I'll see you in the next video.